join the webinar, and then we'll join in about 1 minute's time, if that's okay. Hi everybody, I think we'll start now. We've got quite a few joining, and they'll only miss my bit if they're going to join later on, so it's no big deal. Thank you very much for joining our third webinar of this series. Hopefully you're finding some sort of normality in this new world in week 2 or 3, whatever, it depends on what your normality was. Today we've got some amazing panelists from the VC community, which again, I'm astounded that people have come together so fast and basically pulled this all together in the matter of a few days. We are very, very lucky to have these people who are really busy with their own portfolio companies, but are here to talk to you about what they're doing in the VC community, and also what kind of advice that they're given to their own portfolio companies as well, what kind of actions are being taken, and hopefully you can take some of that advice then back into your own organizations. We also have a speaker, Ian Mitchell-Moore from British Business Bank, and he will give an overview of what's going on in the banking arena. We do feel it's still too soon to do a banking webinar, but hopefully that may be next week once most of the detail is worked out, and he'll give you an overview of that. And we also have Brian from AAB as well, who were on the call last Thursday, just to give you an overview around the VC community as well and what they're doing for their companies as well. So the speakers we have this morning is Paul Atkinson from Power Equity, who is my double act for the last 2 sessions. So yeah, we're now the Richard and Judy or whoever. And Sandy McKinnon from Pentech, Ian Mitchell-Moore from British Business Banking, Alistair Forbes, Jock Milliken from Equity Gap, and Aidan McMillan from AAB, and Brian McMurray from. So over to Paul Atkinson, who's going to say a few words. Thank you.
Morning, everybody. Judy's got me up as the speaker when you were speaking. I'm not sure that's what people are seeing at the other end. Anyway, my name's not Jude McCory, if that's the case. I'm Paul Atkinson, one of the founders of a venture capital firm, Power Equity in Edinburgh. I also chair Taranata Group, which is about a 150-man professional services and recruitment business, and also act as chair of Converse Challenge, and also Clark Communications, who've been supporting SBRC with some of the PR and comms around this program. I guess that gives me an oversight of north of 45 companies and how they're dealing with COVID at this point. We are in unprecedented times. I've lost track of the number of times we've said that. The business impact is very severe and likely to get worse before it gets better. We're already seeing some company failures in different sectors. We will come out the other side though, and we do have to look beyond COVID at what happens next and business resumption. But I think some things will change forever. I think, use of commercial office space and remote working will likely change forever. It's first time possibly ever that we've had something that affects pretty much every sector all at the same time, including the rest of society. And that's why the government support has been so extensive. And it's good to have Ian on the call just to give the BBB background and some of the support measures there. Very, very important. And I guess my community, which I guess my colleagues will say more about, is looking forward to for at least 12 months of fairly severe financial impact, possibly longer. But all of them are assessing both how to respond in the short term, but also what post-COVID might look like. I'm looking forward to the views of my colleagues on this. Certainly from a power perspective, we're planning this for this to be a pretty long haul, with both difficulties and opportunities along the way. But we're certainly up for business, and at this point in time, we have no plans, and none of the power team are furloughed. In fact, we're probably busier than ever. And today's webinar is the third in the series. with my industry colleagues from the funding industry, providing an insight on COVID impact and funding and how venture businesses are meeting the current challenge. First up is a long-standing colleague of mine, Sandy McKinnon from Pentec Ventures. I backed their first fund when they launched quite a long time ago now. They focus on fast-growing technology companies across the UK. Over to you, Sandy.
Thanks, Paul. As Paul said, I'm a partner with Pentec Ventures, and we're an early stage funder.
Sandy, the sound is gone.
Can you not hear me?
Yeah, you can hear you now.
Oh, right, okay. Sorry, can you hear me? Yeah? Hello? Yeah.
Yeah, we can hear you now.
Right, all right, okay, so I don't know what happened there. So yeah, just to give you as clear and accurate we can in terms of, to hopefully help you in thinking through your kind of funding needs and requirements. And as said, we invest up and down the whole of the UK. So I will share perspective from a kind of whole UK perspective, but clearly Scotland is relevant to that as well. And we do invest in Scotland. But I do think it is we are all adapting to this uncertain situation, and it will all change. So what I'm saying, I think, is valid for now at this point in time. And the current crisis is clearly affecting us all. As they'll say, we're all in this together. And as well as your business model being challenged, VC's business models are being challenged. And I think in the last month, I've seen what I would consider probably the best and worst of VC behaviours coming through as people are kind of dealing with this. In terms of the best, VCs are coming together to see how they can help their respective portfolios and syndicate kind of portfolios, and we're also kind of lobbying government and banks to see what we can do for pre-profit companies that are aimed at big markets, to see how we can help them and to see what reliefs we can get put in place to help people weather the storm. One of the kind of things in VC, you're in it for a long time or not a long time. And we've been doing, as Paul said, we've been doing this since 2001. So we've lived through some pretty bad times helping companies in 2004, 2008. And we saw then how companies responded and reacted, battened down the hatches. And so some of that, certainly from 2008, if you were in fintech, it was not a good place to be. And we kind of saw how we could help companies get through that. And some of the biggest companies that we know and love today got through that. So I think, VCs often say, and you've probably heard them all saying, if you look at TechCrunch, we're all open for business. But it is a very different pinch, even in the short time, as I say, that we have. I mean, I've seen, huge rounds in the last kind of 2 weeks. I've seen multiple term sheets being pulled at the 13th hour and massive rounds collapsing. So stuff is, affecting, and it's through the food chain as well. It's not just the VCs, it's their limited partners, it's their money that's, some of that chain is getting broken and is under threat as well. So we're in a different business kind of environment at the moment, like everybody else. So what's changed? I think what we are seeing is that the bar has got a lot higher as you're approaching VCs. I think that's just a fact. I think people will be under more scrutiny, and it will just take longer. My overarching thing is it's just going to take longer to raise money. I still think money can be raised, but it's going to take more to get there. I do think there'll be certain, as Paul said before, about things like a WeWork business model, I think are not going to get funded anytime soon unless you're extremely contrarian. And I think that there are certain sectors that will get funded, and perhaps some of the other people that are going to talk might talk about that more than I've got time to do just now. Valuations will be hit. I think and I've had multiple discussions with multiple companies and other VC peer friends on this. I do think that where before, you might have been going out and giving up between kind of 15 and 20% of your equity for however much you're raising each time you go to the well. I think that's going to be nearer 25 to 30% you're going to be giving up for how much you can get out, you can get to raise. So I think valuations will be less kind of frothy as they've been, and I've said just 3 weeks ago. But I think that deals will get done, and they will just take long is definitely king. You know, you have to give yourself, in my mind, I think ideally giving yourself a funding horizon that gives you 24-month runway is what you should be trying to look at. Yeah, and giving yourself 3 to 6 months to actually raise that money, if at all possible. If you're in a shorter time period than that, then clearly
Sandy, can you repeat that last sentence?
you need to look at doing some more
Sandy.
kind of unnatural acts.
Sandy.
Also, but things like
Sandy.
and sorry about my internet. 6 months to actually, yeah. Over to you, Jude.
So, Sandy, can you repeat the last few sentences you were saying, because the noise or the sound just went?
I'll try turning my camera off, see if that helps.
Perfect.
You don't need my face anyway. Can you still hear me?
Yeah, that's perfect.
I was just saying, you know, I would give yourself a longer amount of time, where possible, to raise the money that you're trying to raise. Deals will get done. It will take longer. Give yourself, I would say, ideally 3 to 6 months to raise the money, because if you're not already in a process, it's going to be much easier. If you're just starting to talk to people, it's going to take longer. You know, and ideally raise enough to get yourself 24 months worth of runway, in my mind. I mean, I think, and part of the thing of it taking longer, like as you've just seen, I've had to turn off my video. I think VC and funding is a people business. You need to meet people, you need to form opinions about teams, and doing that over Zoom clearly has its challenges. And so I think deals will get done over video conferencing, but it will just take longer. So that's that. I can answer more things later, but pass over to you. Sorry about the video.
No, that's fine. Thank you. Ian, do you want to take the stage?
I'll take the stage, but I'll keep my video off. 1, to save the audience from seeing me, and 2, to hopefully get through. Morning, everyone. So Ian Mitchmore here from the British Business Bank. For those of you who don't know much about the bank, we are the UK government's development bank, and our sole aim in life is to get money out to SMEs through a kind of series of delivery partners throughout the UK. I represent the bank in Scotland, and for the past week and a half, I've been inundated with talk about debt, etc. But before we move on to what we're doing there, I just want to let you have an insight as to what we do in the VC market as well. And we are seriously involved in VC activity through about 30 partners at the moment in the UK. We've got about 1.3 billion deployed into the VC market. And we're very much open for business in terms of, if we've got term sheets out, they're not being pulled. We are taking things to legals. Obviously, it's going to take longer as we do things remotely. But there's no kind of message from us that we're kind of shutting up shop. All our existing portfolio of partners have been told to continue sending in drawdown requests, business as usual, and we will process them as quickly as we can. We've also been working on our business finance guide to update that to make it kind of relevant for today's kind of activity and difficulties, and that includes sections on talking to your funder, whether it's an equity funder or whether that's a debt provider. And I'm happy, Jude, to send the link to that you can circulate around post the call. So anybody who hasn't been on LinkedIn in the last week or so can't have failed to notice that there's a huge amount of interest in what we have called our CBIL scheme, so the Coronavirus Business Interruption Loan Scheme. It's an evolving product, and a lot of the kind of feedback so far has been in the negative territory. Now we put the scheme in place in a hurry. Not all the banks were as up to speed as others to kind of embrace it and move on with it. So I think what you'll see on that scheme is subtle changes and subtle refinements as we assess the market and we assess the feedback from the market, and in particular, how the banks are responding to it. So we currently have 41 partners delivering this for us. It's a new scheme, so I think we need to stress that. There's a lot of chat about it's just an EFG scheme, Enterprise Finance Guarantee Scheme, with slightly different terms. I can assure you it's not. It's driven under different state aid rules. It's got different conditions around it, and has increased flexibility around what the banks can and can't do. So I think from the market point of view, I'd like everybody to really embrace the fact this is a new scheme and not a wash and brush up or something that was there already. I say we've got 41 partners. We are in the process of trying to accredit more partners into the scheme. We have been literally inundated with applications from non-bank funders to join in the scheme, and that's going to take us a wee bit of time to process, but we are prioritising a whole host of different funders to try and get them through as quickly as possible. I'm talking a matter of 1 to 2 weeks to get some of them approved, i.e. increasing the choice to the marketplace. One of the big areas of concern, I think, is for VC stroke angel backed companies and whether or not this sort of scheme is appropriate for them. I think that's probably down to the individual kind of company to assess whether they could meet our eligibility and viability conditions that we've put down. And in short, those conditions about viability are that if a company was trading in a reasonable kind of manner pre this crisis hitting, and a short-term injection of some form of debt would allow them to trade through the crisis, and then demonstrate a kind of viable business thereafter, then yes, that's a tick in the box from a viability point of view. My own personal view is I don't think it's particularly relevant right now for early stage, growth stage companies. I think Sandy or Paul indicated that there's lobbying going on to try and either enhance the scheme or kind of amend its terms to try and help out this kind of early stage, growth stage market. And I can confirm those discussions are ongoing. What I can't say is what the outcome's going to be, but I think we've demonstrated very early on that there's enough interest around from us to make sure the scheme works, that things like personal guarantees for smaller loans have gone. They've disappeared from what's happening. And there's going to be more movement on the guarantee point, I think, as the scheme settles down. So I think just keep watching the kind of channels that we're putting out, and we're trying to get stuff out as quickly as possible without bombarding the market and without changing the scheme every day, because I think that would be counterproductive. But look out particularly towards the end of the week for updates from us, and I'll be pushing out as far as I can as well. So I think watch the space for the early stage, growth stage market in terms of what might happen through the BBB schemes. Discussions are ongoing, can't guarantee the outcome, but it is certainly on the agenda. And probably easy to take questions to the extent there are on some later on. Okay, Jim?
Yeah, thanks, Ian. We can do if anybody's got any questions, just fill them in on the Q&A and we'll go through them then with Ian and the rest of the panel. Next up is Alistair Forbes.
Thank you, Jude. Good morning, everybody. My background is primarily in the software industry, but I've also operated as a private investor and spent a bit of time working with an early stage tech investor in the UK, Mercy Technologies. So coming at it from both those perspectives. A lot of what I'm going to talk about is slanted more towards software and tech companies, but hopefully there'll be enough content in there that is relevant for everybody who's on the webinar today. So I think just to start off with the VC funding climate, I mean, you've heard from some of the earlier speakers what they think the outlook on that is. Clearly investors are consumed with their portfolios at the moment. Most institutional investors will sit on maybe 6 to 12 boards, and every one of them is now demanding more time from their investors to work through what the scenarios are. So the amount of time that they've got to look at new deals is very limited. You heard earlier people making statements about open for business and business as usual. I think while investors are open for business, it's certainly not business as usual. There was a survey carried out last week by Jason Lemkin, who runs the SASTOR organization, who ran a poll amongst VCs to see what their expectations were in terms of the amount of capital they were going to deploy. And the feedback he got from about 400 investors was that about 30% of them said that this year they thought they would deploy the same amount of capital as they had in the past. So that means that 70% are going to be deploying less capital than they have in previous years. And about 30% of them said it'll be 40 to 60% less than in previous years, so a long way down. Allocations are being revised, and portfolios are going to need more than had been predicted, so there will be less available for new deals. And unfortunately, most investors are going to be in the situation of having to recognize that they can't save all their children. Businesses that might have been able to get funding before probably will not now. And if the business was underperforming before, then this is going to make it even more difficult for them right now. I think it's important for people who are talking to investors to understand how investors work. So there are different types of investors. So Sandy, for example, was talking about VCs who have LPs, limited partners behind them. Some of those funders will be asking VCs to hold back because of their financial situations. Private investors and angel syndicates are mostly made up of people who are business people themselves, so they may have their own challenges to clear within their own businesses. So that's going to affect their decision making. Ian talked about BBB-backed funds. They're probably going to be the ones that are most able to deploy capital at the moment because they have got allocations that are not being withdrawn, and they are being actively encouraged to put that money to work. So anybody who's operating a fund that has public funding, be it BBB or Scottish Government or UK Government behind them, I think are probably the ones that are most able to continue to deploy funds at close to a similar rate. If you are talking to investors, I think you need to be preparing plans with different scenarios. Investors will always look at a business plan and will do some modeling to see, well, what if it doesn't work out quite like it says it will? Don't make the investors do that work themselves, do that for them. You'll look a lot more credible and a lot more backable if you've done the work to say, okay, here are our expectations, but here's a bad case and a worst case, and here's what we do in each of these situations to make sure that we do preserve the runway, as Sandy was saying, to give them the longevity in their businesses to be able to carry on. In terms of some of the specific steps that companies should be taking, Warren Buffett was said to have a rule number 1, which is not to go out of business. Rule number 2 is never forget rule number 1. The one thing you can control at this point in time is costs. And that will play back into the investor discussions. If you are showing investors that you're being intelligent about how you're managing your costs and extending runway, you're likely to get a better reception because you've clearly thought about what you can do. It's important to act fast and act decisively. You probably need to be making one cut that feels like it's too much. If you're not making decisions that are feeling painful, you're probably not doing enough. I think the furlough scheme that's been announced is a great support for early stage companies. It allows companies to keep people employed, albeit not working for them, but it's obviously better for the individuals and it's better for the companies because you're able to retain corporate knowledge and corporate memory from people who you might otherwise lose. So I think making sensible use of the furlough scheme is a very sensible thing to do. And quite a number of companies are looking at taking some temporary pay cuts so that, you know, we're all in this together mentality applies within companies as well as between companies. I'm sure you've also heard the phrase that hope is not a strategy. The other half of that is that fear is not an option. I think you need to be reevaluating your target market. So some industries are being hit harder than others. If you're currently targeting one of those sectors that is particularly badly hit, I think you need to be looking at, you know, what are the options? Are there adjacent market segments you can go into? How can you flex your business? Use this as an opportunity potentially to reshape your business if you have to and pivot if you need to. I think the ways you can do that are to look at revising what in the tech world they call your ideal customer profile. So who are the people you're trying to target and how are you going to market with them, the customer value proposition. There's been some research done that shows the effectiveness of different value proposition messaging, the kind of sale you're making to your customers. And a year ago, propositions that were around making money for customers were about twice as effective as those that were talking about saving money for customers. That's completely reversed now. The messaging about saving you money is showing itself to be about 3 times more effective than anything to do with making more money right now. And I think that's not surprising. It just reflects the situation that everybody's in. I think one of the really important things, both internally and talking to investors, is what are the metrics you're measuring? Up until now, for most VC early stage investors, top line revenue growth was the single biggest determining factor of their level of interest and the valuations you like to get in your business. And clearly that's gone. Frankly, any growth at all this year is going to be a good result. But investors will be looking beyond that to metrics that were always important to them, but are becoming even more so now. So I think they're going to be looking at things like unit economics. How much does it cost you to acquire each customer? How much do you make from each customer? Because if those are good, then you've got a strong underlying business. They're going to be looking at what's your gross margin on sales. If you have a high gross margin, it means that you can trim your costs and still have a profitable business. They're going to be looking at churn. So clearly some companies are having to cut back on expenses, and they're therefore not using products and services that they have been or would like to be. I think it's particularly important to look at leading indicators of churn in your own business. You can try and manage that. The more you can mitigate that, the better you're going to be. So looking at things like usage rates of the product, engagement metrics, recency, frequency, intensity type metrics in your product. So seeing how people are actually using your product. If you're seeing fewer users coming onto your platform from your customers, that's not a good sign. Clearly, they're seeing this as potentially as a nice to have, not as a must have product or service. And that's exactly the sort of thing that's going to get cut in this current situation. I think there'll be some other interesting effects of this. There's certainly some reports that people are seeing inquiry and demo rates going up rather than down, but that's potentially misleading. People have got more time on their hands, so they are looking at things that they might not otherwise have done. And what you might see is that historic conversion rates are not holding up. They might be lower, so that you get fewer people who will convert from some level of interest into actually a sale. There's already been mention, obviously, of looking at what your runway is. I think if you can get to 24 months, that's ideal. But that's going to be a dynamic thing as well. So I think you need to keep reforecasting that on a weekly basis, and especially in terms of looking at what actions you're taking. Are they enough? Are you preserving or ideally extending your runway week on week, or is that getting shorter? Because getting shorter, you're accelerating into a brick wall, and that's a really dangerous place to be. Final thing I'd comment on was just about communications with investors. I think you need to strike the right balance. As I said at the start of this, they're pretty much overwhelmed at the moment. So keep it short, but make it frequent, and be very specific with your asks. Utilize the full capacity that your investors have got, and that's as well as money. It's things like expertise and networks. So really try and draw on that, but do it in a way that's time efficient for them, because that will help them to get you the right information as quickly as possible, and help them to help you. So I think that's probably enough for the moment. Obviously happy to pick up anything in the Q&A, but Jude, pass it back to you now.
Thanks, Alistair. That was really, really useful and helpful. So I've taken loads of notes as well that we can share around if people didn't get taken the notes during the session. Next up is Jock Milliken from Equity Gap.
Morning, everybody. Everybody here? Yes, good, thank you. I'm Jock Milliken. As Jude said, I look after Equity Gap, which is a business angel syndicate based in Edinburgh, where I also chair the Link Scotland, which is the business angels group for Scotland. Link is at the moment is very much lobbying and trying to get assistance for initially business angels, but through them, obviously, investment into companies. So it's an important part, but I'm mainly going to focus on what we're doing with Equity Gap this morning. We're obviously very much focusing on our existing portfolio, but we are still open to look at new businesses, and I'll come on to that a little bit later. Our existing portfolio, we're focusing on them, contacting them very regularly, asking them to contact us at least on a weekly basis, to keep us up to date as to what's happening, what they're doing, what actions they're taking, what opportunities they're seeing. Because even in this time, there are some companies that are seeing opportunities that are opening up because of the situation that we're in. For example, we've got one that looks at identity help, and they are very much, there's a lot of focus on that, because you can't go to your lawyer to show them who you are. You've got to use something there to help that. So that type of thing, there are opportunities coming there. And I think one of the important things, and it's been touched on already, it is to look at other ways of getting to your customers, or other ways to get to new customers. Almost every distillery in the country is now making hand sanitizers, which is 2 weeks ago they would never have thought about it, but now it is one of the ways that they're going to keep a little bit of business going. It's not going to be enormous, but it's going to keep a little bit of business going. So you've got to think about these sort of things as well, and just look at other ways that you might be able to attract the customers. The other thing, and again, some of this has been touched on, particularly by Alistair, but you need to be looking at cash. You need to be looking at how you can take costs out in this short term, and how you're going to be able to prolong that cash runway. Trying to get cash for early stage companies to last for 2 years is a little bit ambitious. I think if we're looking for 12 months, that is probably sensible and realistic. And where we're looking at later stages, I think 24 months might be sensible, but certainly 12 months is a sensible scheme. And you need to be talking to investors early. The time scale to get investment coming through is significantly increased. And it is important that we get that in that runway increased. But we also need to be thinking about what happens after this, when we come out of this COVID-19 crisis. How do you accelerate out of that? How do you are you going to be ready to take the opportunities that undoubtedly will be there at that time, as people start to move about and engage with people? I think looking at new companies, we are still open for looking at new companies. We have talked to our members, our investors, as to what they're looking at, what they would be interested in at this point in time. Quite a number of them have said that they would be interested in solutions that help us get through this crisis. And we've recently looked at a couple of companies that we're going to take further. One is one that's working on a solution, an application and development of its technology to prevent and also treat COVID-19. They're based up in St Andrews, and they've got some real opportunities, and they think that within about 8 months, if they get funding, they can be able to give a treatment that would be useful and helpful to get over this. It's not a virus, it's a different technology, and I'll not go into that. We're also looking at another one called the food market, which are looking to expand, and they're really looking all about delivery of food to homes and across the country, but also helping small producers and small companies across the country to get their food to there. They're well worth contacting, even if you're a supplier, because they might be able to help you get stuff there. They do drink as well as food, so some of the smaller breweries are using them. So these type of things are investors are saying that they're still interested in and still would put some money into. So looking at opportunities where you can get that is one of the important things that I think you need to be doing. And I think I would reiterate again that it's important keeping in contact with your investors. They will be there to help you, but you need to let them know what you're doing, how you're reducing costs, how you're taking opportunities. And the other important thing that I would say that you need to be doing is, if you are furloughing your staff, you need to be keeping in touch with them. Have a regular conference call with them, or regular communications with them, because you will need them when you start up again. And it's important that they're still on side with you. Now I'll pass back to Jude, and thank you.
Okay, next we have Aidan from Power Equity.
Thanks, Jude. Hi everyone, I'm Aidan McMillan. I'm investment manager from Power Equity. Been working with Paul Atkinson over the last year and a half. For those of you that don't know Power Equity, we are an EIS fund manager, an angel syndicate based in Edinburgh. I'm responsible for sourcing and transacting new deals for Power, and also managing follow-on funding requirements for 12 of our 39 portfolio companies. So I'll be covering a bit more on the current funding climate today, what actions our portfolio companies are taking in response to COVID-19, some further government measures that we could expect that would help the early stage ecosystem, and also what we're doing at Power amidst the crisis. So it might still be too early to give a definitive answer on the new funding climate we find ourselves in, but we do expect investment appetite to drop in the short term. It is clear that the later stage private equity players have retreated, with a number of PE houses already gone pens down on new deals, and the word on the street is that they're turning their focus to the existing portfolio. That being said, the global private capital industry is now sitting on a $2.5 trillion war chest of dry powder, and PE houses will soon likely be turning their attention to new deals at more attractively priced in a more attractively priced market. There will likely be continued investment, but given there's now scarce debt capital in the market, there's likely to be dampened buyout activity. There's also been a significant drop-off in corporate M&A activity, with the likes of Technique FMC putting their demerger on ice until later this year, and Amazon's acquisition of Deliveroo likely to stall. Although, by the way that things are going for Deliveroo just now, I would expect that Amazon want to push through with this at a pre-COVID price. Not to revisit some of what the rest of the guys covered, but with regards to the VC market, I would expect over the next 2 to 3 months, most funders will be focused on their existing portfolio, but that will not stop them from considering new opportunities, with many VCs with institutional LPs still having dry powder ready to deploy. Angel investors are generally sitting tight, and many have suffered losses in the listed markets and are expecting reduced income, and therefore have a smaller requirement for EIS. For those angels still investing, it should be kept in mind that there's a significant number of options for their money at the moment, both listed and unlisted. EIS funds will be reasonably well placed for the next 6 months or so, given that EIS funds' busiest fundraising period is Q1 each year, much of which had already completed before social distancing and lockdown measures took effect in the UK. Therefore, EIS funds will have plenty of money to deploy over the next 6 to 9 months, but likely to have less firepower thereafter. It's also worth bearing in mind that even before COVID-19, the EIS fund market is down 20 to 30% on last year. If we're to look at some of the trends in the VC industry from the 2008 financial crisis, we can see that there was a relatively quick resurgence across VC investments, the impact of which was smaller at the earlier stages. For example, seed investments suffered a 50% fall in Q3 2008, but the market right back in Q4 and continued to increase in volume, while Series A and Series B investments had a nice resurgence in Q4. All said and done, it took 8 quarters for the VC market to return to pre-crash levels. I know that we can't assume that the resurgence from the recession following COVID-19 will follow the trend following the 2008 financial crisis, but it does provide a bit of optimism. As venture investment looks for generally disruptive businesses that are going to provide long-term value over the next 5 to 10 years, many VCs will look past short-term events, and therefore are likely, and there are also likely to be many technologies and businesses that crop out as consumers and businesses adapt to the new normal. One thing that is clear from discussions with others in the VC sector is that pricing and new funding rounds will likely be squeezed, and therefore companies that are currently fundraising may need to be prepared to accept lower valuations. It would also be sensible for companies to take more money if it's on offer to provide a larger cash buffer and extend the runway. We've been spending significant time with our portfolio in the last few weeks on their response to COVID-19. It might be helpful to share some of the measures that our portfolio companies have taken. Many of our portfolio companies have revised their budgets for the year, sensitizing their revenue forecasts and also bringing down costs in order to conserve cash. Fortunately, a number of our portfolio companies have experienced expedited sales cycles due to the sector that they're in, but a number of our portfolio companies have been prudent in assuming extended sales cycles and conversions over the next few months. A few companies have decided to allow struggling customers to take unpaid trials and SaaS licenses, which allows their customers a good chance to use the product and also builds a bit of goodwill. Given that the top line is expected to be muted for a number of months now, a number of measures that some of our portfolio companies are taking in order to conserve cash are furloughing staff where possible, as the rest of the guys have talked about, freezing all new hires and particularly all non-critical hires, management teams taking significant temporary salary reductions or deferrals and asking employees to work reduced hours or taking temporary pay reductions. There's also been freezing of all non-essential overheads such as travel, obviously, and unnecessary marketing spend. We've also been advising customers to delay their creditors as much as possible and pushing debtors for payment. This, however, will get increasingly difficult as their customers will be stretched as well. Portfolio companies have also been delaying PAYE, NIC, and VAT payments to HMRC. It is expected that there will be a national level freeze in tax collection, and therefore a number of portfolio companies already delaying payment, which can subsequently be paid if no support in this form is announced. Portfolio companies are also taking advantage of any rent holidays if they're able to arrange with their landlords and of any business rates relief where possible. And they've also been applying for the UK government's COVID business interruption loan scheme, the Scottish government's business support grants, and any other government support schemes if they're likely to qualify. Obviously, it's still quite early, and the process of going about accessing some of these support measures announced by the government remains relatively unclear. Fortunately, a number of advisors in the market have been helpfully circulating some guidance on going about accessing these support measures. There are a few further government measures that we could expect or indeed want to see in the next few months that would help the early stage ecosystem. The UK government could increase income tax relief for the next 12 months for EIS and VCP. This is easy for the government to administrate and will have a direct and immediate impact on the industry. And they also have a precedent in doing so. VC tax relief increased from 20% to 40% post-dot-com bubble burst, and EIS tax relief increased from 20% to 30% in 2011 in response to the credit crunch. There are also certain EIS relaxations around ASA and CLNs that would help maintain EIS and angel appetite in the short term. The government could also increase pledged capital commitments to approved co-investment partners, such as British Business Bank and the Scottish Investment Bank for the next 12 months. This would again enable government-backed money to be invested on commercial terms with direct and immediate impact. Finally, on what PAR are doing amidst the crisis, aside from the new investment that we're on track to complete today, we are focusing primarily, first and foremost, on our existing portfolio for the next few months, making sure that our portfolio are appropriately capitalised over the next 12 to 18 months. Fortunately, and without turning this into a pitch, at PAR we are lucky to have access to 4 sources of equity finance, a syndicate of nearly 200 members, our growing EIS fund, our co-investment partnership with Scottish Investment Bank, and a new source of capital in the form of 50 million of pledged capital, details of which will be announced in the next few days. We are therefore very much still considering new investment opportunities as well as supporting our portfolio, and are excited to hear from interesting new startups in the coming months. That's everything from me just now, but happy to feed into Q&A at the end. Thanks, Jude.
Okay, and next we have Brian McMurray from AAB.
Thanks, Jude. Good morning, everyone. Yeah, my name's Brian McMurray from Anderson Brown. I'm a corporate finance partner. I am going to attempt to share my screen out a couple of slides just to talk through. So hopefully this works. Is that working, Jude?
Can you put it onto desktop or presentation mode?
Sorry, yeah, give me 1 second, I'll try again, see if. Does that work? Is that, Jude, can everyone see the screen?
Yeah, that's it.
Okay, great, thank you. Okay, so I'm going to look at just some advice for businesses looking to be investor ready during COVID-19. So I'm going to start with just some of the key considerations, and these should be appropriate to businesses, whether it's looking for equity investment or debt. I think the first point is the ability to demonstrate commercial viability, and I think it's looking beyond COVID-19 and making sure that there's still a viable business there. And so that's looking as well at the customer base and suppliers. You know, what impact is this having on them as well? And is the business still viable? So it's really important to get that message across and be able to demonstrate that. The next one, looking at funding requirement, and I think every business at the moment should be looking very closely at their cash flow. You know, every business must be doing a cash flow forecast as a minimum. And I think it's looking at both the short, medium and long term and being able to identify the funding requirement and what those funds are being used for. And I appreciate that that's something that's going to be changing as time passes. So also looking at appropriate sensitivities. So I think more important than ever in the current climate is having a credible management team. So having the confidence that the team that you have in place can get through these challenging times. And I think where appropriate, certainly for some of the smaller businesses where it may be a small team, that's where I think your advisors can come in and provide that support and the expertise to help businesses get through this period and come out stronger. I think looking at all exit options, so for the time being, perhaps putting plan A to one side and actually looking at what are the other options. Do we need to change the original plan? I think being very critical as a business and saying, are we strong enough to get through this? Should we be looking at doing something different? And there may also be some consolidation opportunities. But I think the really important thing here is looking at all options and having those discussions and really thinking outside the box. Also very important, and I know this has been touched on, but looking at the timetable, any business, if they're not already in a fundraising process, it's appreciating that 3 to 6 months is probably a minimum, and it's really important there to look at all the main actions that need to take place between now and securing funding, and looking at who's responsible for those and setting those out clearly so that wherever possible, you can avoid delays in the process. So moving on, just touching on some of the potential issues that we foresee. And the first one there, looking at starting the process too late. As I mentioned in the timetable, it can be a long and challenging process trying to raise funds. So I don't think any business can wait and see how long this will go on for. I think every business needs to be looking at very closely now and starting the process sooner rather than later. Again, another point that's been touched on already this morning, but I think really, really important is identifying the funding requirement, looking at those forecasts, the sensitivity analysis, and wherever possible, trying to secure sufficient funds at the first time of asking. I guess it'll become more and more difficult as a business if you have to go back to the investor several times. I think from an investor point of view, the ask will become more challenging. So I think wherever possible, trying to secure those funds at the outset and first time. Another thing we see, is very common in these processes is the owners spending too much time on the process, and I appreciate that they do need to be involved in the process, but wherever possible, trying to get others in the business or looking to use advisors to help in the process, because bearing in mind that there's a business that still needs to run and there are a number of moving parts. So wherever possible, the owners avoiding getting tied up too much in the fundraising process and giving themselves time to focus on continuing to drive the business forward. And then finally, looking at valuation. So again, this has been touched on, but I think really important for business owners to be realistic in their valuations and accepting that for most businesses, there will be an impact on revenue, profitability. I think the most important thing for businesses at the moment will be raising the funds that they need. So, it's always a difficult one, accepting that the valuation might not have been where it was prior to this, but I think business owners need to be realistic and approach the process with that in mind. And then finally, if we can try and end on a positive, look at some of the opportunities that might exist for businesses at the moment. So I think looking at the products and services that the business has and perhaps looking at are there opportunities during COVID? Are there different markets? Can we look at applying our products and services slightly different and making the most of where we are at the moment? Another one, looking at resources. So I know speaking to many businesses, trying to find resources can be really challenging. I guess, hopefully at the moment, there may be more resources available to rely on. So I think looking at that and maybe seeing it as a potential opportunity to get access to people that may not have been available before. And then finally, again, this has been touched on, but you know that at the moment the EISA are lobbying for changes to EIS, CDIS. So, if you are a business that is looking for EIS investment, then keeping a close eye on that, and hopefully we see the changes that bring some of the investors who are maybe sitting tight back to the table, if there can be some relaxing of the rules there. Thank you very much. I'll now pass you back to Jude.
Hi everybody. I think my panel have been really busy answering all the Q&As that were coming in, so we don't really have that many Q&As coming in at the moment. What we are trying to do as well going forward is set up some sort of mentoring system, because we do realise that because of the level of interest in these events. So today we've had 180 people online, about 400 people signed up. And the last two as well, we had a lot of people. So we do know that people do need help. And what we're trying to do is on a larger scale, but what we're trying to do then going forward is set up one-to-one mentoring systems. We don't have the bandwidth to do it in a large scale at the moment, but if there are people out there that think that they do need support, and we can't wait around, and we want to expedite that, get in contact with me. And we will see what we can do in getting people matched up with you. We have quite a few mentors coming forward now to say that they will spend time. It's all free of charge. And we are looking for some funding as well from Scottish Government to help support this. We want you guys to succeed. But I think one of the messages today from the from the webinar that I basically took, and I think the Irish are very good at doing this. And I don't think the Scots are very good, as hope is not a strategy and fear is not an option, that we do need to make hard decisions. And if you are struggling to make those hard decisions and you feel that you're not being supported or that there is no support for you to do that, please get back in contact with us and we'll try and get some people there to help you navigate and make those hard decisions for your organisation, so you've got something at the end of this. Has any of the other panel got anything to say after any of the session, or we just close it off here?
Hi Jude, you might want to mention the couple of other webinars that we're already envisaging over the next week or so.
Sorry, so out of that thing of hope and is not a strategy, I think, and fear is not an option from Alistair. Friday's webinar is going to be around the people side of things. So we're going to have some HR people going through the furlough scheme, what other companies are doing around this, how to look after your staff, and also mental health issues. And we will have some mentors as well, some business mentors on the session as well to help you with those decisions. And then on Thursday, which probably isn't applicable to this audience, but some people will find it useful, but there is a cyber webinar as well with Kieran Martin, the CEO from NCSC. We also have Police Scotland on it, and PwC as well, talking about all the different scams and stuff that are going on out there, particularly targeting home workers and organisations that know that they've got a remote workforce. So it is going to be a huge issue, but our main aim at the moment is to keep these companies going and have topics that will be relevant to everybody going forward. So keep in touch, join the LinkedIn page, SBRC Covid-19, and we will post in updates and any information that any of the panelists provide to us. And what we're also going to start doing from next Friday on is some sessions, gathering back some of the panelists from over the last few weeks who may have updates, because it is a fast moving environment at the moment. So any updates that are available, the panelists would jump back on a Friday and do an update for everybody, so that we're getting the information out as soon as possible as well to everybody.
Jude,
yeah?
can I just make a comment on, because we're talking about trying to make hard decisions, and it's probably more of a discussion for the people side of things. But, you know, we've been involved in seeing, you know, people go down to 3-day weeks, indeed, to keep all the teams go down to 3-day weeks, not just certain people. And the furlough thing is great, but it doesn't apply to everybody, and it's not going to work for everybody. But, like, you know, taking those really hard decisions of like going down to a 3-day week, it's a super hard thing to ask anybody to do. But you know, for survival's sake, we're seeing people do it. And some of the stuff you can then give back in terms of, you know, you can pay them a day back when everything gets back to normal. Yeah. Or you can give them equity. I mean, the one thing, whilst we're talking about funding, you know, funding is you give me some equity in your company and I give you money for your resources and for funding. You know, your people can be given more equity as well. I mean, there's ways to share some of that kind of stuff in terms of keeping the team together and the bands together. So it's really hard, but I mean, and I think Alistair and others have said it before, taking hard, cutting hard fast, I think always is a better thing. It feels bad at the time. It's hellish at the time, but you know, it's much better than what's the other decisions you can make. Sorry.
Yeah, I would agree entirely with Sandy and my colleagues on that. It's also worth remembering that we're literally locked down plus 1 week at the moment, pretty much. So we're quite early into the process and things are evolving pretty rapidly. On a slightly more humorous note, one of my friends sent me a note saying, I think I preferred Brexit. I'm not sure about that, but obviously it's a tough time for everybody just now, and we all need to work together. And hashtag we're here to help through what we're doing with the SBRC and Jude's team.
Yeah, and I think from my perspective, if I've ever had any hard decisions to make, it was good to talk through with people, because you've got your gut instinct, but you don't know if it's the right thing to do or not. And that is missing. The coffee shop talks, the people that you trust, you know, pick up the phone. I just realized last night on Twitter, I hadn't spoken to 3 of my really good friends who provide that kind of, okay, yeah, we work together, but we also do have a really good laugh together. We can get ourselves through it. Paul's keeping me going with the laughter and the jokes and stuff. But and on saying that as well, we were trying to look to do some sort of webinar with some comedians as well, maybe on a Friday at 4 o'clock or something, to try. We are working really hard. We're having the tough conversations, and we're planning this tough stuff as well. But, you know, call your friends, your business friends, your normal friends, and you know, just keep the conversation going, because it is going to be tough for the next few weeks for everybody and months. Anyone else got anything?
Maybe I could just, Jude, as a final point, just thank all the panelists for their input. It's great to have input from you guys. Thanks for taking the time. It's really, really appreciated. And I'm sure everyone on the call has appreciated that as well. Yeah, you've been absolutely amazing to get this information out. I'm very lucky for everybody to be able to sit down with you guys, because I don't think we'd even get that in the coffee shops and restaurants in the real world or in the old world. Okay, thank you very much, everybody. Thanks, guys.
Thanks, bye.
Bye.
Thank you.